Asian markets rise as U.S. inflation cools more than expected. Asian stock markets climbed after fresh data showed that U.S. inflation cooled more than economists had anticipated. The softer inflation reading strengthened investor confidence across global markets and fueled expectations that the U.S. central bank may slow or reduce interest rate hikes in the coming months. The latest inflation report was released by the Bureau of Labor Statistics. According to the data, the annual inflation rate came in lower than analysts' forecasts. This unexpected moderation in price growth immediately impacted financial markets, not just in the United States, but also across Asia. Why U.S. inflation matters globally. The U.S. economy is the largest in the world, and its monetary policies significantly influence global financial conditions. Inflation is measured mainly through the Consumer Price Index, CPI, which tracks changes in the prices of goods and services commonly purchased by households. When inflation rises sharply, the U.S. central bank, the Federal Reserve, typically increases interest rates to cool the economy. Higher interest rates make borrowing more expensive for businesses and consumers, which slows spending and reduces inflationary pressure. However, higher rates can also negatively affect stock markets because they increase costs for companies and reduce investor appetite for risk. In this case, inflation cooling more than expected suggested that price pressures are easing without the need for further aggressive rate hikes. This was seen as positive news for global investors. Market reaction in Asia. Asian markets responded positively following the inflation announcement. Major indices across the region moved higher as investors reacted to the improved outlook for U.S. monetary policy. In Japan, the Nikkei 225 rose as technology and export-related stocks gained strength. A softer U.S. inflation number can weaken the U.S. dollar slightly and improve trade conditions for global companies. South Korea's KOSPI also advanced, supported by gains in semiconductor and electronics companies. These companies are highly sensitive to global demand trends, and expectations of stable U.S. growth boosted sentiment. In Hong Kong, the Seng index climbed as investors welcomed the positive signal from the United States. Chinese technology and financial stocks contributed to the upward movement. Overall, the regional rally reflected increased investor optimism that global financial conditions may become less restrictive in the near future. Impact on interest rate expectations. One of the biggest drivers behind the rally was shifting expectations regarding interest rates. Investors closely monitor inflation data to predict the next move by the Federal Reserve. If inflation continues to decline steadily, the Federal Reserve may consider pausing rate hikes or even cutting rates later in the year. Lower interest rates generally support stock markets because companies can borrow money at cheaper rates. Consumer spending remains stable. Investors move funds from bonds to equities in search of higher returns. Economic growth expectations improve. The bond market also reacted positively, with yields easing after the inflation report. Lower bond yields often make stocks more attractive compared to fixed income investments. Currency and commodity movements. The U.S. dollar showed signs of slight weakness after the data release. When inflation slows, expectations for aggressive rate hikes decrease, which can reduce demand for the dollar. A softer dollar can benefit emerging Asian economies because it lowers import costs and reduces pressure on local currencies. Commodity prices remained relatively stable, but the improved global outlook helped industrial metals and energy stocks. Since many Asian economies are export-driven, any signal that the U.S. economy remains stable without overheating is considered supportive for regional trade. Broader economic context. The cooling of inflation comes after a period of aggressive monetary tightening by the Federal Reserve over the past few years. The central bank had raised interest rates sharply to combat historically high inflation levels following the pandemic and supply chain disruptions. Recent data suggests that these measures may be working. Slower price increases indicate that demand is stabilizing and supply conditions are improving. However, economists caution that inflation must continue trending downward before policymakers make any major changes to monetary policy. While the latest data is encouraging, central bank officials are likely to remain cautious. They will continue monitoring employment data, consumer spending, wage growth, and global economic developments before making long-term decisions. Risks still remain. Despite the positive market reaction, some uncertainties remain. Geopolitical tensions could disrupt global trade. Oil price volatility may reintroduce inflationary pressures. Slower growth in major economies could impact exports. Unexpected economic shocks could change the policy outlook. Investors are aware that one favorable inflation report does not guarantee a long-term trend. Markets may remain sensitive to upcoming economic data releases. Conclusion: Asian markets rose as investors reacted positively to cooler than expected U.S. inflation data. The softer inflation reading boosted hopes that the Federal Reserve may ease its tightening stance, improving global liquidity and supporting risk assets like equities. Major Asian indices, including the Nikkei 225, KOSPI, and Hang Seng Index, recorded gains as investor confidence strengthened. Lower inflation reduces the likelihood of aggressive interest rate hikes, which in turn supports business growth and global investment flows. While challenges remain, the latest data provides reassurance that inflation pressures may be moderating. For global markets, especially in Asia, this development is a welcome sign of stability and potential economic balance ahead.